Ever heard people say we should go back to the gold standard? It sounds kind of epic, right? Like something out of an old-timey movie with vaults full of glittering gold bars. But what does it actually mean? And would it really solve our modern economic problems? Let's dive in and separate the myth from the reality. So, what is the gold standard? In the simplest terms, it's a monetary system where a country's currency, like the dollar, has a value directly linked to a specific amount of gold. Think of it like this. Every dollar in circulation would be like a claim check for a tiny piece of gold sitting in a government vault. You could, in theory, walk into a bank and exchange your paper money for actual, physical gold. This system forces the government to be disciplined. They can't just fire up the printing presses and create more money whenever they want. The amount of money they can issue is limited by how much gold they actually have. It's a hard limit, a golden handcuff on government spending. Now, the supporters of the gold standard have some really compelling arguments. The biggest one is its power to fight inflation. Inflation, as we all know, is when your money buys less and less over time. It's often caused by a government printing too much money, flooding the economy and devaluing the currency. Under a gold standard, that's nearly impossible. Since the money supply is tied to a finite resource called the government KUA, you can't just inflate the currency on a whim. This creates price stability. A loaf of bread would cost roughly the same amount year after year, which sounds pretty amazing, right? This stability also extends to international trade. If multiple countries are on the gold standard, their exchange rates are fixed. A dollar is worth a certain amount of gold. A British pound is worth a certain amount of gold, and so on. This makes international trade and investment much more predictable and less risky. There's no worrying about your currency suddenly crashing against another. Everything is anchored to gold, creating a stable, predictable, global economic environment. It provides a sense of certainty and trust in the value of money that many feel is missing today. But, and this is a huge but, there's a dark side to the gold standard. A very significant one. While it offers stability, it can also act like a straitjacket on the economy. One of the major drawbacks is that it restricts economic growth. An economy needs a growing money supply to accommodate more transactions, more people, and more businesses. Under a gold standard, the money supply can only grow as fast as new gold is mined. If the economy is booming and needs more cash to function smoothly, but no new gold is found, you're stuck. This can lead to deflation, which is the opposite of inflation. Prices start falling, which sounds good at first, but it's actually disastrous. People stop spending money because they expect things to be cheaper tomorrow. Businesses stop investing, profits plummet, and they have to lay off workers. Deflation can trigger a vicious downward spiral, leading to severe recessions and mass unemployment. Perhaps the most critical flaw of the gold standard in the modern world is its lack of flexibility. Our economies are complex, and sometimes they get sick. When a recession hits, a central bank, like the Federal Reserve in the US, needs tools to help the economy recover. Their main tool is controlling the money supply and interest rates. In a crisis, they can inject money into the banking system to prevent a collapse and lower interest rates to encourage borrowing and spending. This is like economic first aid. Under a gold standard, the central bank's hands are tied. They can't create more money to stimulate the economy because they don't have more gold. They can't effectively respond to a banking panic or a sudden economic shock. It's like sending a firefighter to a blaze but telling them they can only use a limited number of buckets of water, no matter how big the fire gets. This rigidity is why many historians blame the gold standard for making the Great Depression in the 1930s so much worse and so much longer than it needed to be. Countries that abandoned the gold standard earlier tended to recover much faster. So, why don't we go back? Why do the vast majority of economists today shudder at the thought? It's because our modern global economy is a completely different beast than it was a century ago. It's massive, incredibly interconnected, and moves at the speed of light. We need a monetary system that is flexible and can adapt to rapid changes. Tying our entire global financial system to the amount of a shiny metal we can dig out of the ground is seen as not just impractical, but incredibly risky. The world's population has grown, and the scale of economic activity is astronomical compared to the early 20th century. There simply isn't enough gold to support it without causing massive, crippling deflation. Furthermore, the world's gold supply is not evenly distributed. A few countries, like China, Russia, and Australia, hold or produce a lot of it. A return to the gold standard could give these nations immense geopolitical power, potentially destabilizing international relations. A country's economic fate would be tied to its geological luck or its ability to acquire gold from others. Imagine a world where a financial crisis hits, like the one in 2008. Under our current system, central banks were able to take massive, unprecedented actions to prevent a total meltdown of the global financial system. It was scary, but they had the tools to respond. On a gold standard, they would have been largely powerless, watching as banks failed and the global economy ground to a halt. The system that promises stability could, in a crisis, guarantee collapse. That's the paradox. It's designed to prevent problems in normal times, but it can make extraordinary problems catastrophic. It's a system built for a simpler, slower world, not the high-speed, complex, and sometimes chaotic global economy we live in today. So, while the idea of a currency backed by solid gold has a powerful, romantic appeal, the reality is far more complicated. The gold standard offers the tantalizing promise of stability and an end to inflation, but it comes at a steep price. Economic inflexibility, the risk of crippling deflation, and an inability to respond to crisis. It's a system that, while it had its time, is ultimately a relic of a bygone era. Our modern economy, for all its flaws, requires a more dynamic and adaptable approach to money. The consensus among economists is clear. The solution to our modern economic challenges is unbound by looking backward to a golden age, but by looking forward and building a more resilient and responsive system for the future. What do you think? Is the allure of gold worth the risk, or are we better off with our current flexible, if sometimes volatile, system? Let me know your thoughts down in the comments. Thanks for watching, and if you enjoyed this deep dive into economics, be sure to hit that like button and subscribe for more content. See you in the next video.